All right, let's jump right in. We're going to talk about the financial markets. You know, that big, chaotic world of numbers and charts. But what if I told you that beneath all that noise, all those crazy random seeming price swings, there's a hidden rhythm, a predictable pattern?
So here's the billion-dollar question, right? Is all of this just random, complete chaos? Or is there something else going on? A secret beat that we could actually learn to follow if we just listened closely enough? Well, that's what we're going to explore.
And that search for the market's rhythm brings us to a really core idea. It's this basic repeating pattern, a simple 5-3 structure that some people believe gives order to what looks like total chaos.
Okay, so this whole idea has a name. It's called the Elliott Wave principle. But here's the key thing to get. This isn't just about lines on a chart. Not at all. It's actually a theory about people, about us, and how our collective feelings, these waves of optimism and then pessimism, might be the very thing that creates these predictable patterns.
When you break it down, the core idea is surprisingly simple. It says markets move in a rhythm of expansion and contraction. The best way to think about it, just picture the market breathing. It takes a big breath in and then a smaller breath out. In and out.
So let's start with that big breath in, the expansion phase. This is a 5-step or 5-wave move that goes with the main trend. First, you get wave 1, that initial burst of optimism. Then, wave 2, that's the first little bit of doubt, a small pullback. But then, whoosh, wave 3 hits. This is usually the strongest, most powerful surge, because now everybody's jumping on board. Wave 4 is just another little pause, and then you get wave 5, that last gasp, that final push to a new high, even if it feels like it's just running on fumes.
Okay, so after every breath in, there's a breath out. That's the contraction. And it's a simpler 3-wave move that goes against the main trend. It starts with wave A, the first significant drop when fear starts to set in. Then you get this tricky little wave B. It's a brief rally. People call it a bull trap because it fools people into thinking the good times are back. But they're not, because then comes wave C, the final drop that finishes the whole correction.
And this really breaks down the psychology behind it all. On one side, you've got that 5-wave expansion. That's all driven by herd mentality, by optimism. It's the flow. But on the other side, you have the 3-wave contraction. That's driven by fear, by people taking profits. That's the ebb. It's this constant push and pull, a tug-of-war between these two human emotions.
All right, so we get the 5-3 pattern. 5 steps forward, 3 steps back. But the theory goes even deeper. What if there was some kind of mathematical code that dictates the size of these waves, their proportions? This is where things start to get, well, a little weird.
I mean, think about it. What decides how far a market pulls back, or how high a big surge can go? Is there like a ruler we could actually use to measure all this human emotion?
Well, according to the theory, the answer often boils down to this one single, almost mystical number.
You're looking at the golden ratio. This isn't some random number. It's a fundamental mathematical constant that shows up everywhere. I'm talking the spirals in a galaxy, the petals on a flower, ancient Greek architecture, and, if you believe this theory, in the rhythm of the financial markets.
So where does this magical number even come from? It comes from the famous Fibonacci sequence. You've probably heard of it. You just start with 1 and 1, and then add the last 2 numbers to get the next one. So 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5, and on and on. Now, here's the crazy part. If you divide any number in that sequence by the next number up, the answer gets incredibly close to, you guessed it, 0.618.
So analysts take this sequence and pull out these key ratios, and they use them in 2 main ways. For pullbacks, or what they call retracements, they're watching to see if a dip will stop around the 38, 50, or 61.8% mark. And for the big upward moves, the projections, they're looking for targets like 161.8%. The point is, these aren't just random percentages. They're all directly tied to that golden ratio.
Okay, so that's the math. But how does this all become a real tool that people actually use? Let's take a look at how analysts use these ratios to try and map out where the market might go next.
Okay, first up, they use them to measure those pullbacks. So imagine a stock has been going up, 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 and then it starts to fall. An analyst will literally measure that entire move up from bottom to top. Then they'll mark out those key Fibonacci levels below the peak. They're basically creating a map of potential support zones, places where the selling pressure might just run out of steam. And this is where you can really see the human psychology behind the numbers. Remember wave 2, that first little pullback? That one's often pretty deep.
maybe a 50 or 60% retracement because nobody's sure if the new trend is for real. But wave 4, later in the trend, that one's usually a lot shallower. Why? Because by then, everyone's a believer. They're feeling confident, and they can't wait to buy the first little dip they see.
Now they do the exact opposite too. They use the ratios to project forward. So by measuring how long one of the early waves was, they can try to forecast how far a future wave might go and set some potential price targets.
And there are a few classic relationships they're always on the lookout for. For example, that big, powerful wave 3, it's often 1.618 times as long as wave 1. And the final wave 5, a lot of the time, it travels the same distance as wave 1 did. They call that equality. It's almost as if the market has a built-in memory for these proportions.
Okay, now we've got to hit the brakes for a second because this part is absolutely critical. It's so important to understand what this framework is and what it isn't. This is not magic, and it is definitely not a crystal ball.
What this stuff gives you isn't certainty. It gives you probabilities. The best way to think of it is like a map. It's a map of the most likely paths the market could take based on the trails that human psychology has blazed over and over again. It can show you where the hills and valleys probably are, but it can't tell you when a sudden thunderstorm is going to roll in.
So, if it's not a magic crystal ball, then why does it seem to work so often? Well, this is maybe the most interesting part. The theory is that a huge part of its power might just be that it's a self-fulfilling prophecy.
And that leaves us with a pretty wild final thought to chew on. If you have millions of traders all over the world, and they're all looking at the same map, all using the same Fibonacci levels to decide where to buy and where to sell, could it be that their collective actions are actually creating the very patterns they think they're just discovering? It's a heck of a question, isn't it?